Okay, everybody. Good morning, good afternoon. Once again, a wonderfully on-time start for me this summer. About 2 hours behind when I typically would like to start. Not going to stream too long today, but I want to go through a couple charts that I think are pretty interesting. Actually, I've been working on them for a while, and they will give some more color to how our economies are growing and how Bitcoin can fit into this. Good morning, Maximize. Good afternoon to you. All right. So as I have on the screen here, did a little Gemini search. What is the point of Geoffrey West's super exponential growth theory? I've talked about this before. We're going to go through it again. I don't want to do like a lecture, so just let me know if you have any questions about this. But Geoffrey West's super exponential growth theory suggests that certain systems, particularly cities and economies, exhibit accelerating growth patterns that are fundamentally unsustainable in the long run. This theory highlights the tension between the increasing efficiency and innovation found in larger, more complex systems and the finite resources. By the way, I would highlight this as technology. That sentence there, I think it's a fair sentence. I would highlight it as technology. And the finite resources and limits of the physical world. Essentially, it argues that while growth can be beneficial up to a point, unchecked super exponential growth will eventually lead to a singularity where the system collapses due to its own internal contradictions and resource limitations. Again, he wrote this book, Scale, which I highly recommend, about the same time that Ray Kurzweil was talking about his singularity. You know, if we want to talk about a mathematical singularity, it just means faster and faster growth until eventually you're at infinite growth, straight line on exponential scale up. Can't happen. So the system would theoretically collapse. He's not calling for a collapse, or he didn't, I haven't checked with him recently, but this book is an older book. He's just saying that when systems tend to go too fast to this mathematical singularity, they either collapse, and we've had plenty of collapses in civilization before, or they move on to a different treadmill, a faster treadmill, or maybe a new paradigm shift if it gets too steep. It's my interpretation of the super exponential growth. So I had this chart here of the S&P 500 going back to 1800. Again, S&P 500 started in the 1950s, but you can backdate a lot of it, all of it. It's not going to be 500 companies, but just the growth of the index. All right. So again, I showed this already, but I just want to do it again. Look at that index started at 1 in 1800, and then it's at 10 in 1922. It's pretty wild. The growth rate of this green line is 2% per year. The CAGR, 2% per year, 86% R squared. Okay. So I pulled this all the way until the founding of the Federal Reserve. It's a big deal in the United States monetary history. I stopped it. All right. Then let's look at this trend line. This is from the Fed's existence until 1971. All right, we go off the gold standard. It's a faster trend line. You can clearly see it. All right, so we go from 2% to 4%. And you can see what's going to happen on the chart here. The number's quite a bit above the black line. Let's look at the trend now from 1971 until 2008. Until 2008. That's an important caveat. Faster trend still. But 2008 was a big deal. If you didn't live through it, or you didn't really pay attention through it, I guess I should say, probably everybody lived through it watching this, but if you didn't, I sort of cut my economic chops on this during this time, started to read more about clusters of errors in the economy and everything, but free market stuff. It certainly was a big deal. But my question is, did it change the trajectory of the growth of the stock market? And it seems that no, it didn't, because I'm going to put on now the trend from 2008 until today. But we started from a much lower base, which was interesting. Okay, so huge drop here. So again, it's arbitrary, kind of, where you start these dates. But again, roughly, these are major monetary changes in structure. So we went from, gold standard, silver standard, even at the beginning, to a gold standard in the 1870s till World War One, when the Federal Reserve was founded. It's a nice cutoff to change the trajectory. We went to a 4.8% CAGR growth, and then 1971 until 2008, stock market went to a 9.6% CAGR. So you can see it grayed out. We have a faster CAGR from 2008, but it's a little bit weird because the base is lower. So it is faster, but it's a lower base. That's how it looks. Okay. Now, I wanted to look at some other ones. Okay, so let's look at gold. All right. Most people know gold was fixed before, well, two major periods in the United States' case, and really worldwide from the 1930s, was Roosevelt devalued here in 1933 from $20 an ounce to 35. 1971, of course, happened when it free floats again. But then before that is basically 1/20th an ounce of gold was $1, or $20 was an ounce of gold. Civil War in the United States, price did rise. So same thing. Let's just, to assume that gold represents a store of value, let's do these trend line analyses. All right, so from 1800 here until the founding of the Fed, it's very low correlation, in fact, from the average, but basically no growth, 0.1% CAGR on the gold price. Let's look from 1914 until the Nixon shock, all right, 1.3%. Again, it's arbitrary. It's different, because obviously we're still running at $20 an ounce here, and then we move up to 35. But that's what a trend line would give you. Okay, exponential, 1.3% per year, and then obviously we change big time in 1971 and beyond. Really started in 1968. Sort of the wonkiness started in 1968, and then we move on. So let's go and draw a 1971 trend until 2008. All right. %3.3 per year. So faster. But not insane, by the way. I mean, because there's a major bear. Because again, we got to go to 2008. This is literally the time period that I'm looking at with this blue line. It's here. All right, so that's how the blue line is drawn. And then I just extend out. It has nothing to do with post 2008 values for gold. All right, so put all the other ones on. You can see the treadmill increases. The slope increases. And now 2008. Let's go in 2008 until today. All right, same thing. Faster. Not a ton faster, but it is faster. All right, so we go from basically 0 to 1.3 to 3.3 to 4.2. So I think a really interesting portrayal of Jeffrey West's super exponential growth theory. It's very, very good, both for stocks and for gold. Right? Gold looks more or less completely like scientifically correct. Every period that we look at, each monetary epoch, and 2008 was a different monetary epoch with all the money printing that they did, is higher and the growth rate's higher. Again, the stock market's a little bit weird. The base is lower. We had such a drop, but the growth rate is higher again. Something to think about. Okay. What else can we do for long-term measurements of systems? All right, this is difficult because it's economics, first of all, but secondly, you need to find something ubiquitous and something that goes over the long term. Well, actually, United States Treasury bond will do the trick. All right, so here's the United States federal debt. Notice here the Andrew Jackson taking down to zero the debt. which, by the way, in the model, you have to put $1 because exponentials won't work on 0. So takes the debt down to basically 0 here. Civil War, big bump in federal debt. World War I, World War II, big bumps in federal debt. What's the 1800 to the founding of the Federal Reserve trend? 5.4% CAGR. So interesting, that's higher. It's a higher percentage than the S&P or the backdated S&P. Gold, it's like no growth. Debt grew a little bit faster, quite a bit faster, in fact. 5.4% versus 2% is a huge delta. Let's go from 1914, founding of the Fed. Faster, higher. Move on to a higher, faster treadmill. All right, this is from 1914 till 1971. Okay, 8.2% per year. Going to here. This is the only period that I'm running this exponential. So it's obviously, it's lumpy, it's, you know, it's the real world, but you can still draw an exponential trend line. 8.2% per year. Let's put the other one back. All right. Now let's go from 1971 till 2008, U.S. federal debt. Interesting. Here it looks a little bit more like the stock market from the first slide. We have to fall back, right, because the debt was, you know, relatively low to the World War I, World War II trend. So we started at a lower base, but it was faster. Of course, we're still jumping to a faster treadmill, as Jeffrey West said. Now it's a 9.4% CAGR from 1971 until 2008. And now you can see there's going to be a difference if you look in my legend, what is coming. 2008 trend until today for United States federal debt. It's in the news every day. Freak out, freak out, freak out. Everybody. Debt is actually growing at a slower rate now than we have seen in the past. I don't know why. I'm not going to try to, I like to analyze this stuff and just sort of bring the message. I'm not going to try to pontificate on why this is. But it is interesting that with the world's reserve currency and the major sovereign asset that the United States has, the seigniorage that the United States has, that is basically the dollar, the reserve currency that other countries want to hold, they've slowed it down since 2008. They've slowed down the production of debt. You know, something that might surprise most people. All right, let's zoom into the, 80s, 90s. So we can just, I know it's hard to see. This is log scale. I can take that off. Maybe that's a little bit easier to understand. It's log scale taken off. This is not linear. It makes a difference. This is not, again, I'm not apologizing for whatever they do in the government in Washington, D.C., or making it seem like it's more sustainable than it is. But if you go out to, say, 2030, based on the 1800 trend, we're completely off that. 5.4% CAGR would only be project $2 trillion in debt today. U.S. does not have that. It has way more. All right. But the 1914 trend is relatively in play. Right? When I say that, I'm just saying look at where the line is relative to the total. It's in play. All right, we'll zoom out, zoom a little bit more so you can see. It's still in play. The 1914 trend would give us 72 trillion by 2030. The 1971 trend would get us 91 trillion But if we only start our analysis from 2008 trend would only give us 50 trillion. So I wonder if sort of naturally, as the system keeps going on, again, I'm just wondering if it's not necessarily that every time we have to jump from a faster and faster treadmill. There may be situations where the system will adjust and not grow at such a fast exponential rate. But that's more of a query, a hypothetical, than an explanation of why the debt is not growing as fast as it was. Right? There is nothing hiding in these numbers. These are the rates. Remember, the analysis stops at the next trend line. Okay, so here, I stopped the analysis for the 1800s, right? I stopped it at the founding of the Federal Reserve. Here, I stopped it at the end of Bretton Woods. That black line just projects out from where we were in the 1970s, 1960s more. Here, I know it gets hard to see on log scale, but let's even take it off. No, harder to see. Here, moving from the 1971 trend until here, 2008, I stopped calculating the blue line. So the blue line's taken off from the post GFC trend line. So it's the federal debt of the United States is actually an interesting little caveat to the super exponential growth theory, at least in terms of what's happened since 2008. All right, one more. Let's look at another country. This is not the Federal Reserve. This is the Norge Bank. Good evening, Tim. Yeah, we can come back to this. Max, I'll come back to your question here. As always, Bitcoin is a good response to this stuff. But yeah, I mean, if you look at gold, these are not amazing returns. All right, and obviously Peter Schiff hates this trend. And let's focus on gold. Let's do it. Let's answer this question about holding value, because gold is still a store of value. It has a long-term track record of doing so, but we can analyze the performance. Peter Schiff would hate all of these trend lines. Okay, so these are the trend lines. Yes, the price is above all trends today. Okay, you see the price is 3,300 from June close. This is a monthly chart because it's huge. Obviously, it goes back well into the past. Gold is above all trends. But if we take all trends out to 2050, Peter Schiff would not be happy. All right. In the worst case, the 1800 trend, which is never coming back, $25 gold. That's moving from $20 an ounce to 20 by 2050. Not on that trend. 1914 trend, which we're also not on because that's when the moved from 20 to $35 an ounce, and still we were in a gold standard world. $130, not on that trend. 1971 trend, until the GFC in 2008, is a trend that we could be on, roughly. $2,281 gold price per ounce by 2050. And then even looking at the 2008 trend, which again, gold has been flat for a lot of the last 15 years. That's why it's not that great. $5,900, $6,000 gold by 2050. Peter Schiff would hate this chart. Good morning, Gio. Good afternoon. I got a couple charts for you. I got Norway, and also I wanted to ask you about Romania, Moldova, actually. And yes, BTC is even better. 45 by my count, 45% at the moment. But this is like a damning chart for gold. As far as hedging against, what they throw at you. You'd rather be in stocks. in the last 2 cycles, that is the blue and the red line, stocks would at least get you 9%, 9.6% per year, 11.6% per year. Okay, so that's the question about the gold hedge. Remember that this is kind of a wild card. I was actually surprised myself. I wasn't really paying attention to this, when I built it out. But U.S. federal debt from 2008 is growing slower than the prior 2 monetary epochs, which goes all the way back to 1914. Okay. Now let's look at Norway. Norway, I wanted to look at because it's kind of interesting. I do this monetary base analysis, and I look at central bank balance sheets every quarter. Norway, if there was a central bank that would do something right, it would be Norway, obviously. And that's obviously a component of the people, but primarily the oil fund, which is not called the oil fund anymore. It's the used to be called the Global Petroleum Fund. Now, I don't know, Gio, what it's called, the Global Environment Fund or something. But that asset value sits on the balance sheet of the central bank. So I wanted to see how that would grow and just measure that. There was a devaluation or a change in the currency from post-World War II. So it's here. So I'm not counting that. My epochs are going to be a little bit different here for Norway. And it starts in 1877, at least, from current kroner, roughly current kroner values. But we can still do this. Okay, so let's go to the 1877 trend for Norway until 1945. And this interesting. They on the central bank website they'll still give balance sheets for a free Norway, which existed in London. A free Norway central bank balance sheet. So you have that from 1877 until the end of World War II. Growth rate of their balance sheet, 4.6% per year. All right, so again, these are all good analytical tools, I think, to say if this is what the Norwegian central bank is getting, this is what everybody else should be getting too. Of course, this is 100 years ago, so it's not applicable till today. 4.6% CAGR. Now let's look at the 1946 trend until 1991, because 1991 is when they started putting the fund on the balance sheet. All right, so I'm not messing with this, which is just my rough change in the valuation during this time from the new kroner after World War II. Anyway, from here until 1991, which would be here, December, your CAGR is 8.5% per year, pretty fast, actually, for the NOK. Faster than, I don't have the Fed's balance sheet for this analysis, but faster than the United States debt was 8.2, actually close, 8.5 during this rough period. Then let's look from 1991 when they started to put the Global Petroleum Fund on the books, really fast, until the GFC. Okay, so really fast trend, 20.3% per year. And then you can see it, again, an oddity, which I wonder if it is such an oddity, from 2008, flatter trend, 13% per year. Let me know if you guys have any questions on these 4 charts, but the brass tacks of showing this, which I think is interesting, is it does reflect the theory of what Jeffrey West talked about with scale, with exponential systems, with economies. We have stocks, we have gold, we have bonds, and we have Norwegian kroners, money. I'll do the Federal Reserve next time. I don't have them on here, but whatever. I don't have an explanation for why, but I do think it's interesting that in both the United States federal debt's case, which I think just Treasury bills, bonds, and notes, the growth rate has been slower from 2008 than it was in the prior 2 epochs. And the same with Norway. although Norway is still faster in this epoch, the red line is still faster than the black line, right? 13% versus 8.5%. But, you know, they were going gangbusters from 1991. Here's a question from Max about Maximize about Kelly criterion. I am a fan. Stephen, Money or Debt, talks about that a lot. I think it's totally a good analysis to do, but I don't actually personally do it. Again, never financial advice, but I'm pretty hardcore Bitcoin, so now that you bring it up, maybe it's something I should look into more as far as like systematizing it and presenting it, but I don't have any thoughts on it. So back to Gio's point here about 29% CAGR. Let's look at Bitcoin now since 2008. Whoops, didn't put that on right. All right, I've shown this before. The actual returns can be quite wild, right? That's the green line, But if you run a trend line over these green lines, which is basically taking the return of the solid black line, you get this. So with Bitcoin, we have something completely different than the stock market, the gold market, the bond market, or the Norwegian money market, which is also indirectly tied to the stock market because they invest in a lot of stocks in that petroleum fund, or whatever they call it now. So we have this nice, asymptotic, sustainable looking curve. And as you see, the run rate today, which is moving down from 45% at the end of the year. This is already projecting out. Basically, it's the reason it's not exactly 42 or 43 is because it's looking at an analysis from if you bought. It's actually looking at analysis every day, but still, if you annualized it and imagine that you bought in July 2025, holding till July 2026, it'd be something like a 42% return. So that's what it will be by the end of the year on a full run rate. It's kind of hard to explain the slight nuances you'll see there, but the 2025 December return of the curve versus the 2024 December return of the curve is actually a little bit higher than this, but it's a slightly different analysis. Anyway, it's nearly the same. It's not a big deal. So basically, this will update every day based on today's price. So if you went all the way back and Roger Ver or whoever that $80,000 whale was, 80,000 Bitcoin whale, who apparently sold on Galaxy and possibly was running that Bitcoin website that shut down back in 2011. Anyway, if you bought it at $1 roughly on the price, you'd be getting 122% per year compound growth if you held till today. But obviously people don't get that. It gets smaller. So interestingly, with Bitcoin, we have the opposite effect of the treadmill effect that Jeffrey West writes about. With other exponential systems, stocks, gold, bonds, you generally have to move faster and faster. Again, I say generally because we've been thrown a wrench here. And I'm just going to report what I found. It's a little bit slower growth from 2008. Same with the Norwegian central bank. But generally, you're moving faster. But Bitcoin goes the opposite way. Our return in Bitcoin will get less over time, assuming we have the power curve. But the math makes up for it in that we're way above any of these other returns today. So as Gio said, 29%, by my count, is actually 45% is the curve. And obviously it depends on when you bought, right? So here's the actual, right? So I can probably find Geo's 29% somewhere, but here, let's just take off all the curves so you understand. This is just wherever you bought the price, you hold till today, this is your actual return. So you bought the price here, $5 back in 2012, 113% per year return. Good for you. And there's a lot of noise as we get in within a year. A lot of noise. Totally profit, by the way. People say, like, you can't win big on Bitcoin compared to shit coins. You certainly can. And it's certainly got plenty of volatility. So if you bought here, even March 2024, the top $73,000 Bitcoin held till today, today's price, the valuation would give you a 42.2% compound growth. But the math remains very interesting, right? We just do not, Bitcoin does not work in exponential. So when you hear people talk about Bitcoin getting adopted exponentially or growing exponentially, it's just the data doesn't support that. The hash rate isn't growing exponentially. Addresses aren't going exponentially. And the price isn't growing exponentially. And the market cap isn't growing exponentially. Let me know if you guys want to look at something else. I just wanted to lay it out there because this is my most recent findings. I think they're pretty interesting. And, you're not going to find this anywhere else, at least for now. It's pretty long scale encompassing, numbers. And I don't even want to give a conclusion of why, right? It's more of like analyze what's happening and then try to understand, skate where the puck is going. Understand that. This is quite interesting. This, as far as the Treasury debt, I mean, this is contrary to the narrative. I'm not trying to explain it away, but even going out 5 years, the numbers are way different depending on which trend line we pick for the U.S. federal debt. Obviously, we're off this trend. But if we take the most recent trend from 2008, it's actually not that insane as people might think. You see there, the R squares get better over time. But the little bit of a hiccup in Jeffrey West's theory in that the debt is actually growing slower in the last monetary epoch than the two prior. It came from Sailor, yeah. My friends at the Ultimate Bitcoin group, I don't even know what it's called anymore. I'm such a bad marketer. Plan C, Cena, those guys, Money or Debt, Handle Money or Debt, they've looked at this. Giovanni as well. Those MicroStrategy numbers are just not reliable. I don't know why they're doing it. They're trying to pigeonhole a compounding growth figure into something that doesn't grow in compounding fashion. I just would not recommend it. I can wholeheartedly say that I would not recommend MicroStrategy's forecasts of Bitcoin price based on some sort of either rising exponential or declining exponential growth pattern, because that's not how Bitcoin is growing. Thank you, Max. Maximize. So, yeah, I'm still working on MicroStrategy. I know I've said it like a lot in the last week. It's coming. It's coming. I want to let's chart their market cap now. This is obviously something that Saylor himself should understand. He's never spoken about the power law because we talk about it a lot, and he's not recognized it. He'll go on his spiel on podcasts for 2 hours and talk about the amazing things of Bitcoin, but as far as I know, he's never recognized our power curve predictions. And prediction is a bad word. I mean, just our power curve observations, power law observations. I like to call it the power curve because people get triggered by the word law. It's not exponential. It's not an exponential curve. It's a power curve. And he has apparently liked some tweets of some of my friends that are working on this. But again, it is what it is. But it certainly has implications. If MicroStrategy is starting to grow at a more sustainable, gently declining market cap, gently still growing, but the rate of growth is gently declining, a la Bitcoin, as is Bitcoin. So that has serious implications for his debt instruments, which are exponential. Those are compounding debt instruments. I know that like some of them are even zero coupon or whatever, but the idea is still exponential. The world that he's thinking in, the Wall Street world. So I guess he's liked some tweets from the power law crew, but he hasn't. Yeah, Gio, good point. It's a very good point. This is why I like the math. He might be right for all I know. I mean, it might be that it remains some global asset, or the payment network is kind of secondary. But I think that defies a lot of the value proposition of the network itself. So there might be some cross currents there with that view. And what's actually happening with Bitcoin. Again, you can draw lines on charts. That's what I've been doing, right? For all like major assets and things over the centuries. And then you just look at Bitcoin and it just does not, those lines look very different. That's not the best fitting line. Also, if you're tuning in, again, I'm not saying I know that in September 2037, the market or the price of Bitcoin is going to be 2.6 million per coin, 2,600,000 to 8,574. The point is just to show the trend, how it adapts to other things in the future. I do think within the next 10 years, we'll get to something like a Bitcoin standard. I don't know if Jeffrey West is on Twitter. He might not be. But maybe I'll try to. I don't think he's on it. I'm not. I guess some people are. You think it's worth the time? It's worth the brain cells? It's funny that they have launched or they've mapped their hopes on the power law stuff as well. You know, if you look at this one, all right, again, let's take off this one and this one. Oh, sorry, this is Norway. Not Norway. Let's look at the US. Let's take off this one. Let's even take off this one. All right, so the 1971, which is the highest painted trend, and then 2008. I do think everybody's good. You know, I keep saying this. We're so lucky that we have Bitcoin right now compared to any other asset because what's happening here is far and away dominating the story than, say, how much debt there is in the world. It's just not a part of the story yet. Bitcoin is too young. It's scaling up. It doesn't matter. I mean, Bitcoin's entire existence was during this curve. And you can see that it was a pretty consistent curve from the United States Treasury in the last 15 years from the GFC. I mean, look at that, right on trend. Trend is $36.5 trillion. U.S. federal debt in June 2025 is 36.2 trillion, 98% R squared. Bitcoin existed during the exact period that is painted on this chart. And it just does what it does. Which is, again, why it's super lucky to be in this time, to be buying the asset, to be holding it, to be looking at what's happening. U.S. federal debt doesn't have anything to do with the growth of Bitcoin. As I've said, 95% of the growth of Bitcoin has to do with this curve itself, with the adoption. 5% has to do with the other stuff at the moment. Yeah, someone tell me. I'm not going to theorize on this one. Someone tell me. This is the post-Nixon shock trend. Way lower. Way lower. The only theory that I will give is the market. Let me say the market is not entirely fair, but the players around this game have adapted. They have realized that it was 9.4% CAGR from 1971 was not sustainable. And so they actually slowed it down. That's the only caveat that I will give. Not saying any one person had any, it's like a wisdom of the crowd type of thing. But I do think it's interesting because this is the one curve. Well, not the one. It happens in Norway too. It happens in Norway too. It probably happens in a lot of things. It did not happen in the stock market, although the stock market started with a lower base, which is helping this, but whatever. This does kind of buck the trend of this idea of super exponential growth, or the treadmill analogy that Jeffrey West has given, which states that we must every time we move to new technology, a new epoch, a new period, we must have faster. We must jump on a faster treadmill to keep going. Actually, we didn't have that. There's still plenty of terrible things, and the U.S. has no, blue collar workforce that has growing wages. There's a lot of issues, but they slowed down the debt. Another thing I think is interesting, or just always to keep in mind, at least I try to keep it in mind, is this is, as far as I know, this is the same type of analysis that Jim Simons would use, right? Just from what I've read about him, what I've seen him, it's just basic statistical analysis. Just, of course, his models are way more advanced than this, looking at many more periods, but just follow the trend. You might be able to make money. Interesting thought. You mean immigration in or emigration out? Immigration in? Because as it's been kind of crazy, one would think that would cause it to increase more, no? Yeah. Or do you mean that since there's so many undocumented workers, the powers that be kind of don't want to issue so much debt? Yeah, I mean, I wouldn't say that you have to have like labor is necessarily connected to here. Again, I'm not saying that this is some saving grace to the U.S. federal debt situation. Um, it just surprised myself actually when I put all the numbers together. Like here, we increased the debt big time during the Civil War. It was basically flat for 50 years. And this was the most growth in the United States' history, was right here. Post-Civil War America. It was going down. Probably a lot of cheap immigrants during that time as well, for sure, actually. So I don't know. Maybe you're right. I don't know. I do not have an explanation for why it's at a slower rate of growth. But I just think it's interesting that it's way contrarian to the narratives. And it's even contrarian to this super exponential growth theory. For sure. Let me know. I mean, I'm happy to talk about the ideas. Certainly not scientific, right? I mean the whole thing, like measuring all this, right? Like, I mean, here, World War One, World War Two. I think a lot of these technocrats thought that they had things figured out from here, right? During this period is relatively sustainable. Even Bill Clinton tried to balance the budget here. This is all that fuss about Bill Clinton, is just these periods. Then, of course, all the Iraq, Afghanistan stuff grew it again. But I think everybody thought that there was sort of a new normal during this entire period. It is growing slower. As much as 25% slower, so to speak. If you go out to 2040, look at that prediction. 200 trillion, 220 trillion debt versus 100 trillion. It's a big deal. This one's pretty beautifully stair-stepped, though. Doesn't really help you from your, as we know. You might as well have been in stocks, but does show the general trajectory of, what you need to store value. But Peter Schiff would hate all of these trend lines. I could put sort of my ultimate one back again. Did I write over that? Oh, whatever, this one's fine. Just give me a second. That's true, Tim. As you said, it's gold has the Lindy effect on Bitcoin for sure. I saw a headline they were maybe able to synthesize it even more. I know it's been synthesized for decades, like in labs, but like extremely expensive. But yeah. I can do this relatively quickly. Can't quite do it live, but it's not going to be as good. It'll be slightly worse. Although this one might be better, the 2008 trend. They'll just issue more of those. That's a good thing to track, actually. It's how they're rolled. Yeah, this is also why I just don't like CPI calculations. It's very fake. It's very political. It's free lunch. Neither you nor I have any say over CPI, and it's probably not valid. Obviously, there's different CPI metrics for each country, for each city. I think stock market indices, market prices like gold, that's your best bet as far as benchmarking. So 12% is what stocks are telling us you got to get. Or 13% if you're the Norwegian central bank. I should do the Federal Reserve. I'll put the Federal Reserve in next time so you can see that. 20% though when they started that fund. This was indeed a wise move. Here's the one I wanted to show. I've shown this a lot. Let's not worry about that. Let's just look at base money. All right. So here's that. It's just the base money supply, which is very low right now, under trend. 26.8 trillion is roughly going to be my update value this quarter. The trend is 34 trillion. All right, so it's way under trend. And Bitcoin's going to have no problem passing it by early 2040s. So if you want sort of a brass tacks chart, I think it's probably this. This is where we can see the power curve of Bitcoin merged with that exponential trend of other stuff. 8.2% you see there from 2008, okay, for world-based money. So we're just super lucky to have Bitcoin. I don't see what stops that train. I don't see what stops that trend. I'll get silver on soon. You know, and to be clear, I'm not saying like this is a coordinated effort. Like Mitch McConnell is sitting in the Treasury saying, you know, he'd be the last person, obviously, to be saying that, sitting in the Congress and yelling at the Treasury to issue less bonds. Obviously, not saying it's a coordinated effort. It's just, you know, it's just measuring trends over the long, long period. You know, if you think about this as well, because a crash could happen again. And I kind of envision this as analogous to, you know, just not enough juice in the tank, but you just keep revving it, you know, faster and faster. So it's like here we fell off a pretty high level of stock market trend, right? We fell off 50% here in 2008. I'm looking at the trend of the blue line to where the red line starts. We fell off 50%. And yeah, we're going faster in stock market growth, but you know, we're perhaps pointlessly going faster. But then technology is also a part of it. So I'd much rather live in this period than this period. And you can't discount the technological growth. Yeah, they screw it up and make it very hard to understand, but there still is technological growth here. So that's another thing that makes it weirder to me, that they're actually growing slower on the debt. Surprising. Sometimes I get charts that's, or not charts, but I get comments that say, just buy Bitcoin and forget it. Not bad advice. Possibly, Tim. But I don't have a world index going back to the 1800s. I don't think anybody does. So we could look at some UK indices, but we're actually pretty young in a lot of that benchmarking. So anyway, it's buying Bitcoin and forget it is also a total viable strategy. You don't have to believe this curve, but I think it's just as good a theory as anything else. It's sustainable. And then going back to the MicroStrategy analysis, Apple is my placeholder. I've talked about this, right? So this still is kind of weird. Few big stocks can outshoot Bitcoin's growth. Only a few. Most stocks in the world will be lower, flatter and smaller in market cap, but I have treasuries here, right? So there's the same. It's the same thing. Let's check my math. Actually, 7.3% CAGR on treasuries from 2008. What did I find here? 7.1. I don't know the reason, but it's close enough. 7.1. So anyway, it's the same. It's the same thing. It's the same chart. I probably miscalculated the CAGR or whatever, but it's roughly the same trend. And Bitcoin passes that again, 2040, 2041. But some stocks don't. And again, I only show this not to say that Apple for sure will be on this amazing 23% compound trend for the next 50 years. But back to the MicroStrategy philosophy. If Bitcoin becomes as big as it does, I don't see how both can do this. As I've said, either TradFi, here delineated by Apple, moves into power, or Bitcoin moves into exponential. Compound interests, all these fancy derivatives, they will work if Bitcoin's line turns into a straight line. They will not work if MicroStrategy, any other company, Metaplanet, starts moving into the Bitcoin world. You got to be very careful about exponentially increasing derivative instruments or debt instruments. Playing with your underlying Bitcoin. Oh, nice. I'll pull it up then. I'll try to get that. That'll be good to see. I imagine it's going to be less even. You get lower. Usually the U.S. has the best growth. So, well, yeah, I know emerging markets can return higher. So I'll try to calculate it. You know, I've had this discussion a lot with friends from this date, from 2008. This is when I was sort of trying to figure out markets, and everyone's like, is it going to be deflation, going to be inflation? So far, the result is what it's always been, right? It's like technology, certain things deflate, other things inflate. And that's still happening. There's a nice comment. You can always turn the channel. But anyway, yeah, I think this is a good way to look at how some of these markets are growing. But I have to admit, I was a little bit surprised when I saw this. So the only thing to do is just keep measuring more stuff. And this one as well, of course. Norwegian central bank matches the U.S. Treasury markets, and then it's a little bit softer growth from 2008. And I do think this is nice to remind as well, just how good returns you can get in Bitcoin buying the lows, buying the dips. Right? If you bought right here, when Peter Zion is telling Joe Rogan it's $17,000 overvalued, it's $16,000, and you hold till today, that's 114% return. Well above trend of 46% for that time. And since we're at all-time highs, I think I cut this off a month before. I cut off the scale, but obviously I think I cut off the calculation. Might be 3 months, actually. No, it's a month. It's a month, so. Even a month ago, that 15% is actually 196% annualized. So plenty of action in Bitcoin to keep Wall Street excited. Gee, I was curious about Moldova. Don't have to talk about it now. I did a show on Ukraine. Not a show, but showed a couple charts. I guess it was yesterday. So there was some really interesting interviews that Ukraine, the latest, did on their podcast last week, and with some Moldovan leaders that were pro EU, pro democracy. I'm always curious how the Romanians look at them. Russian drone flew into the Baltics yesterday to Lithuania. The EU does a terrible deal with Trump, and apparently he's going to be harder on Putin, but we'll see. As it relates to Bitcoin, I think none of that matters. As I said, Bitcoin was existing during this entire period. So 95% of the action, in my opinion, still has to do with the adoption of Bitcoin, the power curve. Yeah, I think that's true, Tim. I mean, again, I've always said I'm not cheerleading for the worst case scenario. I like Bitcoin and gold as insurance against the worst case. But even the Federal Reserve has dry powder, right? As I've shown many times with that, asset purchases versus central bank asset purchases versus national debt chart, which I'll put up again. It's not at the top. Trump wants lower interest rates. Trump wants more money printing. They're at least 10 percentage points lower than they were in 2021. Would you support them joining together with Romania? I know that there's a lot of. I mean, I understand from the Baltics, right? Because we have this indoctrinated minority, let's say, not a huge minority, but it can be difficult. Yeah, I mean, the one politician I was listening to said that he would support it as well, but it just would take time. Crazy days. Yeah. I don't know what you do about that quagmire. Just goes to show you communism ruins everything, right? Even if you got to look back 100 years to the communist rot. So, yeah, I agree with you, Tim. I think there's more dry powder than people think. There's a lot of sky is falling than people think. Still rocky. I'm still thinking back to the April Liberation Day. Let's see how the foreigners are purchasing treasuries. We'll see. But it's not like, it would be an entirely different thing if this red line was like Jeffrey West has theorized. Oops, that's Norway. And it was higher and faster than the blue and the black line, but it's actually not. Yeah, no, I understand. I understand. It's Moldova is Soviet Romania, more Soviet than Romania had to deal with in the Eastern Bloc. I don't know all the history, but I understand that. This is a big issue for you. I mean, that's going to be the indoctrination for the minority. And another thing I heard from these episodes that in the recent elections where they got the pro EU, pro democratic parties in, there were some was it 8%? It was a huge number that they factually verified had gotten paid from outside sources to vote, presumably from Russia, to put a vote in. So the corruption is rampant there. You know, I heard the same thing about Sweden. Of course, in Sweden, it was just the other way. You know, the Fabergé eggs and the gold that the Bolshevik regime had, the little that they had, that's the only thing that they could use to try to build up the communist government. So they've laundered it, sold it basically through Sweden. There's some books written about this in Swedish, but I want to try to find out more about it. But, you know, the United States didn't start recognizing the Soviet Union until the 30s. It took Europe like 2 years. You know, from 1918 to 1920, basically, and most of the wealth was laundered through Sweden. This, of course, is the opposite story. I didn't know this, but it's interesting. Why would, whose decision was that to send it to Tsarist Russia for safekeeping? It's like the Spanish sending gold to Stalin. You're welcome. Tea time. Thank you for the nice words. Appreciate that. I mean, this is just like who was the NFL player that let Putin look at his watch and then Putin just took the watch? This is their style. Completely different society, no morals, no scruples. If they can steal something, they'll steal it. No property rights, no courts. Just thug dictatorships. But Tucker Carlson likes them, so must be all right. Not if it was World War One. In the start of World War II, when the Soviets took over the Baltics, June 1940, 9 months after Poland was firebombed by the Nazis and the Soviets, the Soviets sent a message. The Balts, as Poland had done as well, they had gotten a lot of the gold out of the country. I've talked about the Polish gold before. It's a great story. If people want to learn about how the Polish gold, fled both the Nazis and the Soviets. But the Baltic gold, most of it was in London, and the Soviets sent an identical message for each of the three accounts. It's like transfer the gold, please, back to the Soviet Union. Transfer the gold, please, back to the Soviet Union. Like they said it for each of the three accounts for Latvia, Lithuania, and Estonia, and the UK, of course, ignored the order and kept the gold there for the entirety of the Soviet Union. But yeah, I don't have much hope for you. Certainly not these days, my friend, that Romania is going to get anything back from Russia that they might have bargained with. I've talked about it a lot, but this is a very nice book. George Tabor, Chasing Gold. Incredible story of how the Nazis stole Europe's bullion. Highly recommend it. We would have some action if the United States would revalue the gold that they apparently hold. As I've said, so this is their holdings in dollars of treasuries, the vast majority of their assets, like the lion's share. The gold is marked to market at $42 an ounce, so it's, peanuts, but it would be close to $1 trillion at today's prices. So it's something. If they have it, of course. Yeah, it's an incredible story. Some got confiscated, I guess, in Romania, but most made it through. The vast majority made it through. They let it go through by train through down to Constanza, and then a British ship from Mobil picked it up. I guess American company at the time, Mobil, but it was a British ship, I'm pretty sure, British run. Took it to Istanbul, and then it went by train through the Middle East to Lebanon, Levant, French Levant at the time, and then a French ship took it back to France. It's really an amazing story. You can find, if you're curious about all that stuff, it's a lot of the movements of gold during World War II. They're all there. And in my little speaking circuit last summer to some of the Bitcoin conferences, I did some presentations on that. I need to put them up on YouTube. It's heavily drawn, obviously, from those stories, from his and a few other books. But I love good research like that, where they can make it a bit more personal, tell you what the people were thinking at the time. Because people don't talk about that a lot with the history of these wars. They don't talk about that. It was like the first thing that Hitler went for was the gold in Czechoslovakia and in Austria. Also, why the United States came to be the most dominant superpower for many reasons, but the monetary side of it, it was something like 80% of central bank gold ended up in the United States during the first years of World War II. French did not want to send it there, though. Together with the Polish gold, they went down to Africa for a while. It was there. What goes down must go up. That's for sure, as Tim says. I'm not cheerleading it on, but you can see how wacky their balance sheet is. It's going to come back up. And yes, I need to do a little multi-trend line analysis of the Fed's balance sheet, just like I did for Norway. So, all right, guys, I'm going to leave it there today. More stuff coming. Hope you enjoyed this. Please like, subscribe, share. And I really just want to learn myself and keep this stuff free. So if you have any ability to support me here, it's my BTC Pay. Thank you, Tim. Good night. Let's leave that as a cliffhanger, Gio. I think if the sailor view becomes dominant, it's possible. Sailor's not managing those keys. So sailor's not managing those keys. It's totally possible that to some effect, some of this Bitcoin story could repeat what happened with gold. To be continued. Yes, they are. I have heard that they are repurposing a lot of Swiss bunkers for Bitcoin mines and for just holding. It's pretty wild. Switzerland's not perfect either, right? You see Proton Mail was leaving Switzerland for their privacy laws. All right, guys, I'll leave it there. Thank you for watching. Have a good Tuesday. Talk to you tomorrow.